Here's a question for you. Why do most investors, and yeah, I'm talking even the pros, consistently fail to beat the market? And maybe more importantly, what can you actually do about it? Today, we are diving headfirst into one of the most important investing books ever written, Burton Malkiel's A Random Walk Down Wall Street. This quote from the book just nails it, right? It perfectly captures the wild, often irrational heart of a speculative frenzy. It really gets at this powerful force that drives so much of the market, our own human psychology, where logic, well, it often gets thrown right out the window in favor of pure, unfiltered greed.
And this right here is the classic playbook for a bubble. The dot-com era, a perfect, almost textbook example. It was a time of just insane optimism, where companies like Pets.com, with zero profits, became household names. VCs were just throwing billions at startups, and people were calling it the greatest legal creation of wealth in history. But, what goes up in a mania-fueled rocket ship has to come down. And when it did, the crash was fast, it was brutal, and $1 trillion in investments just, poof, vanished.
But here's the thing. This kind of mass delusion, it isn't new, not by a long shot. This pattern of boom and bust has been repeating itself over and over throughout history, and honestly, with an absurdity that's almost comical.
I mean, just take the Dutch tulip mania back in the 1600s. People got so utterly convinced that tulip bulbs were the future that prices shot up to levels that are just mind-boggling. Get this, in one famous story, a sailor just grabs what he thinks is an onion to have with his lunch. Turns out it was an incredibly rare tulip bulb worth more than he'd make in his entire life. It's the perfect, tragic story of how a collective craze can turn a simple flower into a priceless treasure. Or what about the South Sea bubble in 18th century England? The speculation was so red hot that one guy advertised a company with a business plan that was, and I am not making this up, a secret, and people lined up around the block to give him their money. Of course, he took the cash and was gone the next day. It just goes to show, in a mania, the fear of missing out, or FOMO, just crushes any kind of logical thinking.
Okay, so if the market is just this wild, irrational beast, shouldn't we be able to rely on the pros, the experts to navigate it for us? It sounds totally logical, right? But let's see what the actual evidence has to say about that. So when it comes to trying to beat the market, you've basically got two main camps. On one side, you have the technicians, or chartists. They believe everything you need to know is right there in the stock's price chart. And on the other side, you've got the fundamentalists, who are the detectives, digging deep into a company's books to figure out what it's really worth.
So how do the chart gazers actually do? Well, study after study has found that the patterns they swear by are usually just random noise. Like seeing shapes in the clouds. Looking back, sure, the chart might seem predictable. But in the real world, trying to predict the future with it is no better than flipping a coin. And as the book points out, a classic excuse from a technician who gets it wrong is, I failed to believe my own charts. All right, so what about the fundamental analysts, the ones doing all that homework? Well, the challenge they're up against is just staggering. Over a 15-year stretch, 95% of professional fund managers in emerging markets failed to beat a simple plain vanilla index. Let that sink in. Despite all their expertise and all their research, they still underperform. So why? Why is it so ridiculously hard for them to win? Well, the whole game is kind of stacked against them. You've got totally unpredictable world events that can wreck any prediction. Companies can use creative accounting to sweep problems under the rug. And let's be real, analysts are human. They make mistakes. Plus, they're often under huge pressure to stay positive, especially if their firm wants to win that company's banking business.
So, if the experts can't reliably win, maybe the biggest problem isn't something out there in the market. Maybe it's right in here, in our own heads. And this brings us to the absolutely fascinating field of behavioral finance.
I mean, this question is really the heart of the whole thing, isn't it? We all know the mantra. We've heard it a million times. Buy low, sell high. But when you look at how investors actually behave, as a group, we do the exact opposite, over and over again. Why on earth do we do that?
Well, it turns out our brains come preloaded with these little glitches or biases that are just terrible for investing. We have a herding instinct. We want to do what everyone else is doing, even if they're all running towards a cliff. We have loss aversion. The pain of losing $100 just hurts way more than the joy of gaining $100 feels good. This makes us panic and sell at the worst times. We also get way too confident when we're on a winning streak, and we irrationally hold on to our losers, just hoping they'll come back. And if you need proof, just look at this chart. It's kind of painful, actually. It shows a flood of money pouring into stock funds right at the peak of the market in 2000.
That's hurting and greed in action. Then it shows a massive rush for the exits, with money flying out of funds at the absolute bottom in 2008. That's fear and loss aversion. We consistently let our emotions call the shots at the worst possible moments.
Okay, so if we can't rely on the experts, and we definitely can't trust our own gut instincts, what are we supposed to do? Are we just doomed? Well, fortunately, the book offers a really elegant and, you know what, a surprisingly simple solution. And the solution really starts with this Nobel Prize-winning idea. Modern portfolio theory completely turned investing on its head by proving something that sounds kind of backward. The key to managing risk isn't about finding safe things to buy. It's about combining different types of risky things in a really smart way. This little table shows the magic perfectly. Imagine you own two businesses, a beach resort and an umbrella company. One makes a killing when it's sunny, the other when it rains. By owning both, you've suddenly created a business that makes stable profits, no matter what the weather does. That, right there, is diversification in a nutshell. And this leads us to another huge idea, the efficient market hypothesis. Now, it sounds complicated, but the concept is actually simple. Just think of the stock market as a giant, super fast brain. By the time you hear a hot tip about a stock, millions of other people have already heard it, and the price has already changed to reflect that news. This means trying to outsmart everyone is pretty much a fool's errand. So all of this leads to a beautifully simple and honestly a liberating conclusion. Stop wasting your time and energy trying to find that one magical stock, the needle in the haystack. Instead, his advice is brilliant. Just buy the entire haystack. Own a tiny piece of every company through a low-cost diversified index fund.
All right, theory is great, but how do we actually put this all into practice? Well, the book boils it all down to a time-tested strategy, a set of 4 simple rules that anyone, and I mean anyone, can use to build wealth over the long haul.
And here it is, the disciplined path. Number 1, start saving early and do it regularly. Your savings rate is going to be way more important than your stock picking skills. Number 2, own the whole haystack. Diversify across everything with low-cost index funds. Number 3, rebalance once a year. This is so cool because it automatically forces you to sell a little of what's done well and buy what's done poorly. It forces you to buy low and sell high. And finally, number 4, tune out the noise. Ignore the talking heads, ignore the hot tips. Just be patient and stick with your plan. And look, this isn't just some fringe academic theory. We're talking about the giants of investing. Benjamin Graham, Warren Buffett's mentor, and Buffett himself. They have both said this is the right strategy for the vast majority of people. They, more than anyone, know just how hard this game is to win. And that really brings us to our final thought. After all the market craziness, after all the data, the ultimate lesson here seems pretty clear. Maybe the secret to being a successful investor isn't about finding some hidden piece of information or being smarter than everyone else. Maybe it's just about having better behavior, about mastering that enemy in the mirror.